Open any beginner trading manual, and you will find the exact same diagram for market structure, a neat, jagged line moving steadily upward in a sequence of higher highs and higher lows. But apply that surface-level mapping to a heavily manipulated, volatile asset like spot gold, and you'll realize the textbook model is mathematically incomplete. Look at this sequence. Price punches past a previous high, triggering retail buy stops, but immediately rejects the level, leaving a long wick before reversing. These trapped buyers provide the liquidity institutions need to fill massive shorts without slippage. What the retail trader identifies as a valid breakout, algorithmic trading systems engineered as a deliberate liquidity hunt. To trade alongside institutional capital, you must abandon these simple visual patterns and adopt a strict mechanical framework for validating market structure. Continuing to trade off surface-level breakouts ensures one outcome. Your capital serves as the necessary liquidity for institutional profit. We have to start by establishing mathematical proof before we label any peak on a chart as a true structural high. During an aggressive upward leg, the market never moves in a perfectly straight line. It creates minor pauses, inside bars, and small internal pullbacks along the way. Rule 1 states that the absolute highest point is unconfirmed until the price reverses downward and sweeps the low of the most recent minor pullback, marked here by the horizontal line. The high only becomes legitimate at the exact moment that specific internal low is breached. We define this deliberate sweep of an internal minor pullback as inducement. Algorithms use inducement to coax early buyers into the market, specifically to hit their stop losses and harvest their liquidity before initiating the true directional move. Trading off a peak before this sweep happens puts you directly in the crosshairs of that liquidity hunt. Waiting for the inducement sweep confirms the structure is actually solid enough to risk capital on. Without an inducement sweep, any perceived structural high is a mirage, designed to capture premature capital. Once you have a confirmed swing high, the next step is defining what happens when the price attempts to push past it. This split compares two structural breaks. On the left, the candlestick wicks above resistance but closes below. On the right, the candle body closes firmly above. A wick extending past a high indicates a liquidity sweep and rejection. For a valid break of structure, the candle body must close convincingly above the level. That brings us to Rule 3. The process for validating the swing low. You cannot identify a swing low in real time. You can only define it by looking backward after the valid break of structure candle body has officially closed. The confirmed swing low is the absolute lowest point of the entire retracement move that caused the breakout. By strictly requiring a candle body close to confirm a break, you systematically avoid buying the absolute top of an institutional liquidity hunt. Even when traders get the structure right, they often mismanage the trade by using the terms retracement and correction interchangeably. They represent entirely different algorithmic environments. This diagram shows a retracement, a temporary pause with low volume and orderly cascading candles, pulling back precisely into the 50 to 61.8% discount zone. The institutional intent is efficient. Algorithms pull the market into a discount to pick up unexecuted buy orders and mitigate local order blocks. A retracement is deliberately designed to look weak, tricking retail traders into opening counter-trend short positions just before the dominant trend resumes. A correction is a completely different mechanism. It is a deep, prolonged, macro-structural rebalancing phase. On the right side, you see a correction. Notice the chaotic, jagged structure. Volatility is extremely high, with multi-wave price action sweeping repeatedly past the 78.6% level and breaking internal structures without establishing a new trend. Its algorithmic purpose is to induce panic, wipe out weak-handed position holders, and seek deeper value to rebalance massive macro imbalances. Misdiagnosing a macro correction as a simple retracement causes traders to hold losing positions in fear, while the algorithm executes a massive structural rebalance against them. Once you have mapped the macro structure, you have to shift your focus down to the individual candlestick footprints to verify where Tier 1 capital is actually being injected. This sequence shows what we call normal candles. They're characterized by small bodies, extremely long wicks on both sides, and erratic, alternating colors. This is market noise. It represents low liquidity retail participation and market orders simply offsetting one another. There is zero institutional intent behind this price action. Impulse waves behave completely differently. They are the direct footprints of central banks and Tier 1 institutions deploying millions of lots in a single direction. An impulse wave appears on the chart as a series of large, explosive, full-bodied candlesticks moving rapidly with almost no wicks. This explosive momentum leaves behind a specific structural footprint, the fair value gap. As shown in this three-candle sequence, a distinct gap forms between the top wick of the first candle and the bottom wick of the third. The gap mathematically represents an imbalance of supply and demand, which acts as an algorithmic magnet for future price delivery. Trading inside normal candle noise is gambling. Tracking impulse waves is how you objectively read institutional direction. We can see exactly how these rules organize chaos during a major economic release, like the U.S. non-farm payrolls report, which routinely triggers massive volatility in gold. Watch this chart. A massive 150-pip impulse wave prints, breaking resistance with a firm body close and leaving a fair value gap. This confirms a valid structure break and sweeps internal inducement. A retracement then cascades down, tapping the gap, before sharply reversing upward. The sequence provides a clear rule set. Never trade the noise. Wait for the impulse wave, map the valid structure, and execute on the retracement. By adopting this strict sequential framework, you stop operating as the market's engineered liquidity and become a systematic manager of algorithmic probability. Ever look at a stock chart and feel like you're staring at pure, unpredictable chaos? For most of us, these jagged red and green lines look like a heart monitor going haywire. Look closer, and those sharp spikes and sudden drops start to look like heavy footprints. They are the tracks of a giant, the massive financial institutions and banks that move billions of dollars every single day. Because this giant is so massive, he has a problem. He can't move easily. To take even a single step, he needs an enormous amount of fuel. And in the financial markets, that fuel is the money of everyday traders. If you want to stop getting stepped on, you have to learn how to read the map. And to do that, you only need to recognize three distinct shapes this giant leaves in the dirt. Shifting your perspective from guessing where lines might go to tracking physical movements is the first step to seeing the market like a bank does. Let's start with the first footprint, the trap. In the professional world, this maneuver is called inducement. Here's how the trap is set. As the price climbs, it pauses and dips slightly, creating a little valley before inching back up. To a regular trader, this valley looks like a safe, sturdy floor to stand on. Seeing this floor, traders decide it's a great time to buy. They place their safety nets, their stop-loss orders, just under that dashed line, assuming the price won't drop that low again. But the giant is watching. He needs fuel, and all those stop-losses are sitting right there. He pushes the price down just far enough to trigger those orders, scooping up that money for fuel before rocketing back up in his original direction. Institutional traders have a strict rule. A true upward move hasn't started until the giant dips down and clears out that pocket of money. If you jump into a rising market before you spot the trap, your money is likely to become the fuel for the giant's next leap forward. Once the giant is fueled up, he takes his next step. This second footprint is the march, or what pros call a break of structure. Now loaded with energy, the giant stomps upward with incredible force. He pushes the price straight up, cleanly shattering the ceiling of his last highest point. To confirm this is a real march, the giant must take a heavy full step past that old ceiling. We look for the solid block of a candlestick to finish completely above the line. A thin little line poking through is just a toe dip, it doesn't count. This solid push tells you the buyers have massive strength, and the giant is firmly in control of the direction. Seeing the march is your confirmation that the trend is healthy and it is safe to follow the trail. Eventually, the giant turns around. This brings us to the final footprint, the pivot, known technically as a change of character. Imagine the giant tries to keep marching uphill, but he's exhausted. He takes a step, pauses, and tries to push up to a new high, but he stops short of where he was before. Then the price crashes back down, slicing straight through the lowest valley of that entire previous wave. This movement shatters the foundation that was holding the whole upward climb together. This is a much bigger deal than the minor dips we see in a trap. While a trap just looks for a quick bit of fuel, a pivot destroys the level that was protecting the entire trend. When that deep baseline breaks, the giant spins his body around. He is now walking back down the mountain, and the old trend is dead. Recognizing the pivot is your strongest defense, saving you from buying into a market that has already reversed. Institutional analysis is simply the art of watching these three movements happen in order. Look at how they string together into a repeating cycle. The giant sets the trap to gather fuel, executes the march to advance, and performs the pivot to reverse. This rhythm works in reverse, too. Whether the market is soaring or sliding, the process mirrors itself flawlessly. Think back to that chaotic, confusing chart from the beginning of our journey. When we lay the giant's tracks over it, the chaos becomes a readable map. Every sharp drop was a trap, every surge was a march, and that final collapse was a clear pivot. You don't need to be the biggest or richest player in the market to win. You just need to know what you are looking at. By avoiding the traps and reading the tracks, you can quietly walk right behind the giant toward success.